Who said the best investments need to be in sexy stocks? This fund manager wants you to care about building safety inspections and commercial food service. After this interview, we think you just might. From Equity Mates Media, this is Basis Points, a show that helps advisors find small improvements that compound into big outcomes. I'm Ren, with my co-host Bryce, and today we're chatting to Milford Asset Management about finding opportunities outside of the Magnificent Seven. Bryce, good to be with you.
Good to be with you, Ren. I'm pumped for this one because too much of my portfolio is in the Magnificent Seven.
Well, I mean, too much is a relative term. You know, if you'd held the US stock market for the past 15 years, you doubled your money.
True.
Doubled it again.
Definitely.
And then doubled it one more time.
Feels good.
So the last 15 years have been good.
So we're sweet.
But as we know in investing, good things don't last forever.
No.
And the question is, how long does this last?
That's it. Well, we're going to unpack that plus a lot more with Alexander Whight, who is Portfolio Manager and Head of Global Equities at Milford Asset Management.
Today we're going to talk about Milford's view of the world. They started in New Zealand, but they're truly global fund managers now. And they have a particular interest in, I guess, some of the less sexy parts of the market, as we called it in the introduction. But there is nothing unsexy about strong compounding returns.
That's it. Now, we want to say a huge thank you to all of our launch partners for Basis Points. That is Milford Asset Management, Orbis, and SIBO. But today, particularly, a thanks goes to Milford Asset Management.
Yeah, Milford Asset Management is Australia's boutique investment firm that works hard for your clients to capture the upside and minimize the downside.
Milford's active management investment philosophy means they keep a close eye on the markets and look beyond current trends.
They know that in volatile times, capital preservation is as important as delivering long-term risk-adjusted returns.
If you'd like to find out more about what Milford can do for your clients, check out milfordasset.com.au. Before you invest, be sure to read the Milford Fund's product disclosure statements and target market determinations, also at milfordasset.com.au.
Well, Bryce, with that said, let's get to our conversation with Alexander Whight.
Well, Alex, welcome to Basis Points.
Yeah, thanks for having me along.
So, Alex, we want to start with Milford's view on the world. You've been in business more than 20 years, $27 billion under management. You would have seen all different types of markets in that time. So, at a philosophical level, what approach does Milford take?
From a philosophical standpoint, it really boils down to two things for us. One of those, or first and foremost, is being active, and then really just trying to find good quality companies that are that we don't have to pay too much for. What we find is that if we have a real conviction in the underlying quality of the business and its market position, etc., then it helps us, I guess, behave the right way when things don't go sort of work out as you might have expected in the near term. That investing, as with most things in life, doesn't always work out exactly how you planned.
Yes.
And having that real belief in the quality of the business, I suppose, built off sort of hard work, is something that we find helps us sort of evaluate what the next step is when things don't sort of work out as planned. For us, active does mean a number of things. So it means actively being different to the benchmark. It means actively showing up each day to create competition for capital. It means actively focusing on the downside as well as the upside. It means actively being invested alongside our clients. Most importantly, not necessarily investment related, but being active in the way that we communicate with clients as well. So we've got over 100,000 clients that have placed their trust in us. Whilst there's the regular communications that go out when we do go through times where, say like COVID or something like that, we sort of try and dial that communication up rather than hide away. And so, whether it be sort of short form video that's sent out to clients to explain how we're managing through and what we're seeing out there when there is that sort of heightened uncertainty, that's a really important piece of what sort of being active means to us as well.
Yeah, nice.
Well, that's a perfect segue because we want you to communicate to us like we're one of your clients, because I think Bryce and I and a lot of people listening are certainly feeling a lot of uncertainty at the moment. Well, I'm not sure uncertainty is the right word. It's just been really noisy this year is probably how I would describe it. Just the news and markets, there's been a lot happening and it's hard to sort of grab onto anything and know what's real and what is just noise. So how are you approaching this year, and what do you think have been the most important developments that will really, be important over the longer term?
Yeah, I think it's barely 2 months old, but it absolutely has been like just headline after headline, right, over that 2 months. I think our sort of best ideas are sort of somewhat independent of that noise. We actively look to sort of find investment ideas that are sort of somewhat in charge of their own destiny. Now, obviously, not everything's completely independent of that. But I think maybe before touching on the noise, perhaps worth thinking also about just where markets are coming into this year and where we've been over the last couple of years, because I think that does dial up the sensitivity to some of that noise that you talk about. I mean, if we look at the S&P 500 over the last 2 years, there's only 28% of stocks that have outperformed the index return in that period. So it's barely 1 in 4 stocks that are actually doing better than the overall market indices are doing, which is pretty startling. And if we compare that to certainly in the last 30 years, that's the lowest it's been. So it's been a really narrowly led market. It's been narrowly led by in terms of some of the large cap stocks that have been outperforming, and then not just the large caps, but really anything exposed to that AI infrastructure build out phase. It has driven like a sort of quite a unique sort of narrowness or concentration in the market. When we think about some of the sort of news flow and noise of this year, then certainly that AI infrastructure trade and sort of where are we on that journey has certainly been called into question a couple of times. A lot of it's been political related in the US. The new Trump administration, what's he and his crew doing in terms of tariffs? What are they doing in terms of government expenditure and areas that they're going to target for cutting, that sort of thing. So it's probably those two dynamics that I'd really call out as being sort of most noisy and most impactful for where we are. That concentration point I think is really important. Like historically, when we do get to these extreme levels of concentration, and there are some measures that suggest we're sort of at the most concentrated we've been since the 1960s. But when we are at these sort of levels of concentration, historically we do see a real pickup in volatility in the 12 months following. You get top decile type volatility after being in these periods of concentration. And so in that respect, we think really important to be mindful of the skews within your portfolio, how diversified you are, whether it be by stock or by factor, or whether you're overly sort of positioned for one particular macro outcome.
And so with things like the AI hype and the political environment that's going on, how are you seeing that flow through to different areas of the market, I guess, outside of the big seven?
Yeah, I mean, outside of the big seven, I mean, we've certainly seen, on the AI side of things, it's been a bumpy ride in January and February, and so, some of those stocks have sort of bounced quite quickly and come back to to where they were prior to, say, DeepSeek's news and that sort of thing. Some of them have not. For us, we're fairly selective in that area. We're not ringing the bell or calling the top, but ultimately the way we look at that space is that it is going to prove to be cyclical at some point. And so we're just, I guess, quite mindful of valuations and what's being baked in. Do we want to pay 25 or 35 times for a company that makes fan blades going into data centers? We don't. That said, if the top line sort of holds in there for long enough, then that'll look just fine, but it's just not a risk that we're willing to take. And so, I think there's been, we've got some modest exposure there, but really when it comes to AI and that sort of thing, we're trying to uncover stocks that are perhaps at the application layer that are going to be able to monetize AI in a more sort of sustainable fashion, I suppose, with recurring revenue, that sort of thing. So in the software space. When it comes to some of the actions from the new administration, healthcare has obviously been in the sort of the crosshairs, I suppose. And here you've got areas in, say, life science tools. So the companies that are making the tools and instruments and ingredients that go into the research and development and production of medicines, those companies are being sort of, the share price is being weighed on because people are worried about the level of R&D spend in pharma and what that sort of looks like over the coming years. Similarly, in areas like hospitals and managed care or health insurance in the US, there's fears around what some potential cuts to parts of their revenue pie or revenue mix, if you like, could mean for the earnings. So we think that all three of those areas are creating some opportunities. We're not massively overweight healthcare at this point. We're sort of running pretty close to the benchmark. But we do think that there's opportunities emerging there because these stocks are being impacted by all the noise that's out there. And we think that there's some opportunities where that noise is being perhaps overly baked into share prices. From a tariff standpoint, Our exposure when it comes to industrials, B2B, that sort of thing, we've intentionally focused more on industrial services companies, so companies that are somewhat immune from the tariffs. But now as we're sort of progressing through the reality, if you like, the actual installing of these tariffs, we're certainly doing the work on capital goods, transports, those sorts of companies to identify where perhaps share prices are being sort of overly impacted by some of the headline noise.
Alex, we're going to take a quick break to say thank you. Well, say thank you to you at Milford Asset Management.
Having your client's best interest at heart is the core of being a financial advisor. And this philosophy is replicated at Milford Asset Management, where Milford employees invest alongside you, putting their money in the same funds as your clients, so they are just as invested in the outcome as you are.
With a globally experienced team of 40 plus across both sides of the Tasman, they've earned a reputation for managing risk while delivering strong returns for investors over the long term.
If you'd like to find out more about what Milford can do for your clients, check out milfordasset.com.au. Before you invest, be sure to read the Milford Fund's product disclosure statements and target market determinations at milfordasset.com.au.
Thanks to the Milford Asset team for helping us launch Basis Points and helping us keep all of our content free. Well, let's get beyond the headline noise and talk about Milford's research process. And we're going to close this section by asking you to bring a couple of examples of companies that you're investing in or that you're interested in at the moment. But let's start at the very beginning and at the idea, inception process. How do you approach, globally, you've got 40,000 options to choose from. How do you start filtering that universe?
That's what makes global so fun, right? It's just that you're just so spoilt for choice, and we do try and be flexible in the approach. We're not sort of biased to one particular style or something like that. So we're not filtering that universe down to 100 stocks or 200 stocks and focusing all of our effort there. Instead, we sort of try to look fairly broadly and identify where we then want to go deep and evaluate the individual investments. So when it comes to idea generation, though, it all starts with the team. So we've got about 40 investment team members spread across Auckland and Sydney. Of those 40, 12 to 15 spend most of, if not all, of their time on international equities. And we tend to be the analyst teams organised along sector lines. So they're developing a lot of expertise in those particular sectors, whether it's healthcare or industrials or technology, and really building from the bottom up their understanding of the opportunity set. You said 40,000 companies. We do sort of narrow that by liquidity, so that gets us down to about 2,800 companies, I think. So it's still a few hundred companies each that each analyst or each team member is able to sort of select from. And so there's a lot of just looking for where quality might be, where might that quality be mispriced, alternatively where might the quality be improving. And so we could sort of almost characterise it into those two buckets, where you've got that sort of traditional compounder type investment, good quality companies that we think are trading too cheap, or alternatively companies that are going through a bit of change, and where that quality is on a sort of an improving trend. We complement that bottom up effort, if you like, with top down insight. So we've got an asset allocation team who spends a lot more time on that, on the top down, on the macro, and that's sort of a complement, I suppose, from an idea generation standpoint, where that can feed into that process as well. And then the other complement would be some fairly simple quantitative screens. So just again, trying to shine a light on quality, be it high returns on capital, good balance sheets, etc., and then shining a light on where that quality might be available for a discount. So there's no sort of one answer, but it's a sort of a whole. We're really drawing on a whole lot of different sources for that idea generation.
Let's drill down a bit on the criteria there. Like, what does a company need to meet for it to actually be considered in the fund?
As I say, we are sort of style flexible. So we've got what we consider good quality value stocks, like traditional value stocks. Cyclical, often it's a cyclical type play, and then we've also got companies that are higher multiple, but good quality companies where really the investment thesis might be centred on just the duration of growth or the sort of how long they can sustain high returns on capital, more of a traditional quality growth type of investment. So we will consider ideas that have varying metrics and characteristics. I think at the end of the day there is a desire to have companies that we consider good quality. And so what does that mean? That means that the company usually will have good economics for starters. It will have a balance sheet that's appropriately levered. We don't screen out high leverage because sometimes that high leverage is perfectly appropriate for the nature of the cash flows that the company generates. And it'll have a management team that's executing on a strategy that we can get behind. So it's as best we can from the outside, a capable management team. If we can, as best as we can evaluate that team, we want to be aligned with management that's executing on a sensible strategy. Typically, those companies will be in growing end markets. They will, like the exceptions would be where it is more of a cyclical type story where you're really just extrapolating the low point in a cycle. Maybe there's not as much sort of through cycle growth. They might be a bit more mature. But the core of the portfolio really will be companies in growing end markets where they've got strong market positions. They'll be at least sustaining, if not growing, their market share. I guess the final piece, like this is a lot of the sort of characteristics of the company. The final piece would then come down to the stock. And here we'd be looking for where we can see upside to estimates, or at least, no downside to estimates. We're expecting the company to be able to deliver on market expectations or surprise positively. And then secondly, that they're at a multiple which we believe's, like for our really high conviction positions, a multiple that is well underpinned. And perhaps when we look across the market at peers or we look at the growth that they have, has decent scope for upside. But importantly, the investment thesis isn't centred around that re-rating. It'll be like we're looking at companies that are generating enough earnings growth for us to make a good return out of the investment, even if the earnings multiple doesn't change. But if we can find a stock that meets that criteria and has significant upside to the multiple as it sort of executes on what we believe it will execute on, then that could be a pretty compelling setup because you get that blue sky re-rating potential as well.
You make the criteria sound so simple.
Yes.
It's in the doing, I guess, that's the hard part. One element of that I want to follow up on is the assessing management, because you said, as best you can from the outside. And I guess that's the challenge being a global fund manager based in New Zealand and Australia. It's that getting FaceTime with some of these, global CEOs is harder. Yeah.
That's a challenge.
Yeah. So what are some of the things you look to? Because this is a challenge for advisors and for retail investors, for everyone in Australia really looking at stocks globally. So what are some of the metrics or criteria or factors that you're looking at when you're considering a management team from across the other side of the world?
Yeah, no, it's. There's certainly some value, I think, in being in the room with management. It helps you get a better feel for what's sort of motivating them and some of the nuance around how they're executing, what they're trying to drive culturally, that sort of thing. Despite being on this side of the world, we do get those opportunities. Maybe not with the really, really large mega cap companies, but there's a heck of a large universe that's smaller. And when we I was going to say when we travel, but it's not only when we travel. So when we travel, I've got great experiences where you go down to Cleveland or somewhere like that, and you get 2-3 hours with the company, including an hour with the CEO, and then you get to tour and meet some people in R&D and sales. Like you get really, really good access. But even from Australia and New Zealand, we've got reasonable overlap in terms of time zone, and so we can make calls with the US at in the morning year round.
Just not Europe.
Europe's harder. It means after dinner calls and that sort of thing. Yeah. So it's not impossible, but it does interrupt family life or whatever else a little bit more. But I guess building that relationship usually initially with investor relations, but then over time, once you've built that relationship, we've got lots of examples of where you then get a virtual, especially these days after the pandemic, you get virtual access to a CEO, CFO, anyone else in the organisation that the company's sort of open to. So the access is there. I think the other thing that we look for is just what are they doing? Like looking at what strategy they are executing on. Are they doing what they say they do? Do we think the strategy makes sense? To help us evaluate that and also some of the cultural sort of elements of that strategy. We do utilise pretty heavily expert networks. And so, we're able to speak to formers from the company or other people that are, perhaps working at competitors or customers or suppliers to get a better understanding of one, the industry, but two, of exactly what that company is doing. And, that for us has been an important step in evaluating some ideas, particularly where Perhaps the company makes a lot of acquisitions. And so being able to speak to formers from some of the acquired companies to understand what do they really do when they, after they've acquired that company, is a sort of an important step in the process. So, I think being in the same room and being able to look management in the eye is perhaps a little overplayed in terms of, the sort of value in that. And, I think we've got both enough, the access that we need, and then there are enough other sources of information that go into that kind of assessment to get a reasonable evaluation. Where we don't have a reasonable evaluation, we'll manage the position size. So it might be that we'll own a company in smaller size until we've been able to flesh out the succession plan, or until we've been able to flesh out that post-acquisition integration, whatever it might be. And then as we build conviction, we can scale that position up over time.
Now, normally it's us asking you questions, but one AI tool that we've been playing with that I think is worth shouting out here, if you're assessing management from the outside, you guys might want to use this. We've been playing with Notebook LM, which is the Google one, and you can upload company documents and then query the AI on it. And so you can put like 20 years worth of company transcripts and annual reports into it, and then query it and ask like how the strategy's changed over time, how they talk about the strategy changing over time, have they been consistent, have they delivered on it. And it's interesting.
It's a great tool, isn't it? We've it and I guess Perplexity is probably the other one that we lean on. Obviously, in different ways. I mean, the way you can upload those transcripts or upload those documents and kind of quiz it and get a summary from Notebook LM is fantastic. Even in our sort of meeting prep, like if we're meeting a new company that we maybe, we're not as familiar with the industry, the way that you can use these tools is just, it's a real time saver for us. And ultimately, that's our bottleneck at the end of the day. Like we're trying to create that competition for capital, and the quicker we can get up the curve on new companies and new industries, and the more competition for capital that we can create, the more new ideas we can be bringing in, and alternatively, the deeper we can go on those ideas that we have selected.
I love Perplexity. It's completely taken over Google for me, but I find it interesting that it's definitely overweight fund managers. When we speak to them, they often mention the use of Perplexity. So
I think for us, the initial sort of selling point on it was just that you could very quickly click through to see the source.
Yes,
so if you did think, oh, that's a surprising kind of response, then you could very quickly see where it was getting that response from. Whereas, some of the other tools, at least initially, felt a bit more black box.
Yes, I am. Sorry.
But I mean, even Perplexity, right, is not without its faults.
Yes,
I've had some great experiences there trying to get it to say the right thing.
So Alex, bringing all of that sort of investment philosophy together, what should advisors know about when you consider the construction of the fund?
Yeah, no, good question. I think for us, with this strategy, and Milford's got a number of different strategies, but for our global equities strategies, we're really trying to position the fund so it's not overly exposed to one particular macro outcome or one particular investment style. So we do try and balance the styles that we have within the fund, the style exposures, and how exposed we are to interest rates going up or interest rates going down. Ultimately we want to have the outcomes of the fund driven by the stocks that we're picking, and not by getting one particular macro decision right or wrong. And so we're really trying to build a fairly concentrated fund. We're sort of usually between 25 and 35 stocks globally. So concentrated but quite balanced from a macro and factor sort of standpoint.
So let's bring that to life with two examples that we asked you to bring here today. The two companies were API Group and Aramark. And for each of them, we want to unpack what the company does, why you find it interesting, or where the opportunity is, and then are there any risks that would potentially break the thesis?
API Group, I think this is a really good example of what we've been talking about. And so it's an industrial business. That API Group effectively is an industrial services firm that will install, inspect, and maintain life safety and security systems. So if we look around the room in here, you've got the smoke detectors and the sprinklers and the fire alarms, that sort of thing. They do it also in security, so looking at security systems, and then they've just recently acquired a business on the elevator service side as well. The interesting thing about all three of those businesses is that they're fairly resilient as well to the macro. And so when it comes to, if we take the fire and safety piece because that's the lion's share of the business. It's mandated either by regulation or by the insurance companies that might be insuring the building that those systems are inspected, at least on an annual basis, sometimes even more frequently than that. How many widgets your customer's selling or how profitable those widgets might be at this point in time, they still need to have those systems inspected. So API will go in, it'll fill out an inspection report, list some defects, and then it'll pull through service and maintenance work on the back of that defect list. And that defect list has to be addressed in order for the building to remain compliant. And so for every $1 of inspection revenue that they generate, they pull through. They say they pull through $3 to $4 of sort of maintenance work afterwards. So it's a very fragmented industry. API is the number one player globally. They've got about a 10% market share.
Wow.
There are thousands of other smaller operators there that typically tend to focus more on the installation work because it's bigger ticket. Like an inspection and maintenance order might only be a couple of $1,000s, whereas an installation project could range, up to $1 million perhaps. And so, if we think about the customer behaviour, that installation work is much more competitive because you go out to tender, you get a few different players in. When it comes to getting your facilities inspected, often it's just the one player, and they've got it almost becomes a recurring revenue type stream. And so API, unlike the rest of the industry, is really focused on inspection first rather than the project piece. And so for us is quite compelling because it's much more resilient to the macro. They're able to by sort of focusing on the incumbent buildings that are out there, the installed base of buildings, they can have a direct sales force that's kind of driving in to win that inspection work rather than spending time tendering and sort of looking at new bids on new construction projects.
And so when you go back to your investment process, you think about like the qualitative, quantitative overlays and the macro. What's the investment thesis behind it?
So the investment thesis is effectively that you've got a company that's somewhat independent of the macro and somewhat independent of the political landscape. So that was an important consideration for us as we moved through last year when we were approaching the elections and when you weren't sure what the outcome was going to be. We were trying to find companies that we believe would be sort of fine, regardless of who ended up sitting in the White House.
They don't agree on much, but they agree on fire safety.
For now.
For now.
For now they do, yeah. It hasn't been such a hot topic. They are looking at generating, in our view, mid-teens or above type earnings growth, and we think that earnings growth has a long duration. There's a long period of time where they're going to be able to generate that type of EPS growth. And the stock's trading on around 19 times earnings. It was a little bit cheaper than that when we bought it, but 19 times earnings for a business that we think for several years can generate sort of 15% plus EPS growth is pretty compelling. If it delivers that 15% EPS growth and the multiple stays at 19 times, then in 5 years' time we will have doubled our money. Mm-hmm. If we look across at sort of high quality or reasonable quality industrial service peers and some other sort of industrial aggregators out there. So you've got companies like Cintas and Rollins, Core and Main, Graco, IDEX, the whole waste management space, even Ecolab. I wouldn't necessarily put it from a quality standpoint quite as high as those businesses just yet. I think it can improve and get there, but it's growing faster. It's got very dominant market position. It's got a long runway for growth, and could this trade a few turns or several turns higher? Quite possibly. I mean, all those companies I just listed trade between 24 and 45 times earnings. So there's a lot of blue sky potential, I suppose, to that multiple that could come through as the business wins over investors. So it's only been listed 5 or 6 years, and it's only a 10 billion, 11 billion market cap.
Yeah, right.
Just quickly on the downside, what are the risks, or most importantly, like what's the thing you're watching that would break your thesis?
Yeah, I think the operational risk is reasonably low on this one, partly because of how resilient it is, partly because the management there has been in place for 20 years executing on a very consistent strategy. So I think that the main risks would be part of that earnings growth algorithm is M&A, and so it acquires other players in the industry, which is what really because it is so fragmented, gives it that long duration growth. There is always execution risk around a large deal. They have made some large deals in the last couple of years, but the results there have been really impressive. So I don't think that's a risk today. But should they announce another large deal that they don't execute on properly, then that would obviously impact confidence. And then I think the other risk from an execution standpoint would be more around management and succession. So the CEO has been in the seat for 20 years. He's not going anywhere yet. There we've sort of built confidence through what we've learnt from the company directly and also from the expert networks in terms of the way that they are training leaders right across the organisation. So it's a really interesting and valuable aspect of the corporate culture. And so, I guess, this is one company where initially we were smaller while we built our understanding of that. But we're sort of fairly comfortable to be able to manage that risk. But I think it's a key person risk and execution around large deals would be the main ones.
Well, if you look at their website, they're obviously thinking about building great leaders in the future, because that's literally what they say on their website. In fact, everything above the fold says nothing about what their business does. It's all about building great leaders and building the future of their business around people. So
yeah, it's a people business.
They must
right?
be on
and
it.
It's a people business, and that's what the lifeblood of the company is. So we've done some trips to their headquarters to look at some of their training facilities and that sort of thing. And it's really unlike anything we've looked at before.
Nice.
So Alex, the second company that you brought today was Aramark. What does Aramark do?
Yeah, so in some ways similar in that it's fairly resilient in terms of the revenue stream. It's a services company. Aramark provides contract catering services. So they provide those services to education facilities, sporting facilities, correctional facilities, healthcare, so hospitals and things like that. And they'll provide, and then just business and industry as well. So it's a fairly fragmented industry as well. There's sort of 3 or 4 players globally that control about 15% of the addressable market. About half the addressable market is still being in-house. It's done in-house. So the canteens, if you like, for want of a better word, are sort of being done by the facility themselves rather than outsourcing. But there's a real trend towards first-time outsourcing, which is driving sort of mid-single-digit plus type earnings growth. Aramark it depends on which region you look at, but it's one of those big 3. It sort of over-indexes to some of the less cyclical end markets that I just mentioned. So when the macro turns down, you still have on-campus eating facilities. People in prisons are still being fed. It's another business that we expect to do sort of mid-teens type earnings growth, but it's trading on sort of 18, 19 times as well. It's a little bit different to API in that the investment case rests a bit more on margin expansion. API has margin expansion as well, but Aramark is going from sort of 5% type operating margins, fairly skinny. It's all about scale in that industry. And as it builds scale, it's sort of growing that margin from 5 to sort of 6 and then 7, and that's all a step. It's another point on the journey. But if you're going from 5% margin to 7% margins, that's a heck of a lot of earnings growth that's going to come through. Whereas API might be going from 13.5 to 15, which is obviously just proportionally not quite as big a driver of that earnings thesis.
I think you covered off most of the thesis there around winning market share at the top line, expanding margins at the bottom line. Is there anything else that really goes in?
Yeah, I think the reason that the opportunity exists is that this is probably another example of improving quality. So this was a business that was grossly mismanaged in different points of its history. It was taken private, came back to the public markets with a lot of debt, and the management team at the time really just absolutely decimated the sales force. So you went from having 120, 130 sort of salespeople down to 40.
Was it a private equity buyout that loaded it up with debt and then relisted it?
It absolutely was.
Yeah.
And anyway, by 2019, the organic growth, you've cut that many salespeople. Organic growth was just diabolical. The retention of customers was poor. And Mantle Ridge, which is an activist investor in the US, came in. They instilled the current CEO, John Zillmer, who's really righted the ship, I suppose, and got the sales, reinvested in sales again, focused on shifting incentives, building that sales force, and now they're at a point where they're able to it's sort of past the risky part of the turnaround, I suppose, and they're actually just needing to execute. They've got the platform in place, and now it's about driving scale in procurement. So winning business, maintaining their customer relationships, and then driving scale in procurement. That's the sort of number one driver of margins. And then from a G&A perspective as well, just getting some leverage in that part there. He's incredibly operationally focused, John Zillmer, and really this is a good quality business in its industry. That was mismanaged, and now it's sort of returning to I guess operational excellence at the end of the day.
Getting it right just so private equity can take it out again in the future.
Well, if at 19 times, if it doesn't re-rate over time, then there's probably a private equity sort of scenario where you can still make those numbers work. So maybe that is a possibility at some point.
And when you think about the risks, what are you watching out for?
Yeah, I think here, as I sort of alluded to around that's the margin expansion. So it's so important that they get the margin expansion right, but they also can't do that at the expense of the top line. And so I think if we think about the thesis, because you're getting quite a bit of earnings growth from the margin expansion, if they can't deliver that, then it's going to call into question that earnings growth. And if you're at 8, 9, 10% earnings growth instead of mid to high teens, 19 times is perhaps a little more fair value rather than cheap. So I think that's probably the main risk that I'd call out.
So I think it's a good reminder that not that these companies aren't sexy, but they wouldn't be the sexiest companies. Contracted food services and safety inspections for buildings. There's a lot of opportunity in investment markets in some of the companies that don't capture the imaginations and headlines of the media, I think, is my takeaway from this.
Yeah, I mean that's what gets us excited when we find something that we think's a little bit of in left field, but just looks very, very compelling from a multi-year perspective.
Now, Alex, we want to close out with one question. Just at the back end of last year, you hit the road for an advisor roadshow, and we're just interested to know what were some of the big takeaways from that? What were some of the common questions that you were getting from advisors at the time?
Yeah, so it was just prior to the elections, so there was a lot of focus on how we were managing through the elections. Not too many people asking who was going to win, but just how are we managing sort of risk and opportunity through the elections? And then the other point, which was really topical, was just around market concentration. Where have we gotten to? How does your portfolio look? I think there's a lot of just advisor worry, I suppose. I don't want to put too strong a word on it, but just that we are very concentrated at the top end of the market now, and advisors are looking for ways to, I guess, protect the downside a little bit, or at least diversify the sources of upside. You can obviously get access to the big end of the market through a passive index ETF, something like that, but there's risk attached to that.
Well, Alex, that brings us to the end of today's episode. Thank you so much for joining us on Basis Points. We really do appreciate it, and I'm sure a lot of advisors and everyone listening today took a lot out of that, so thank you so much.
Great. No, enjoyed the discussion, so thanks for having us along.
Thanks, Alex. Well, that does it for this episode of Basis Points. Thanks for joining us. Make sure you're subscribed wherever you're watching or you're listening so you don't miss another episode. If you want to join the conversation, if you can't wait for the next episode, make sure you subscribe to our email where we're delivering more content, and you're following us on LinkedIn. That is our social media of choice for this series.
That's it. Now, huge thank you goes to our launch partners, Orbis, Milford Asset Management, and SIBO for the ongoing support of this new initiative.